welcome on stage. Hello, everyone. Help me to welcome on stage our colleagues. Matthew Zampa from Zampa Debattista. Gordon Einstien from CryptoLaw Partners, and Bernice Saliba from Caledo.
Sure.
Okay. So, I believe we're the last panel, or there's another panel just after us. So, the last topic of today, we'll be speaking about tax and blockchain, how blockchain and tax correlate together. I remember just over a year ago, we were sitting on these chairs trying to figure out how we can create a framework or guidelines to regulate blockchain transactions. I remember that over a year ago, we were getting lots of business in Malta on cryptocurrencies and transactions with cryptocurrencies, and we were just about to figure out how to tax them. Tax, there's always something challenging in tax. And tax and technology particularly, there's always a challenge how to tax the new technological projects, or how to tax new technology. And I think exactly a year ago, we managed to pin it down here in Malta when the tax authorities issued guidelines on how to tax cryptocurrencies and blockchain projects. Matthew, what's your take on this? What happened in this year? Do you think that the guidelines were effective to encourage businessmen to come to Malta, to invest in Malta?
Yes, basically, guidelines are always welcome because they provide sort of certainty on the tax treatment of a particular transaction. Effectively, the guidelines define certain concepts which are particular to the blockchain space and are very welcome because the tax legislation did not change as such, so you need to have some guideline which would define certain concepts, and then you can apply it within the tax legislation. We also have three guidelines. We have the tax guidelines, income tax guidelines, the stamp duty guidelines, and the VAT guidelines. What's important to note is that for the purpose of analyzing a transaction within the DLT space, you still need to follow the principles innate in the tax legislation or the VAT legislation, as in the guidelines are, as the name implies, a guide. They are not exhaustive, as in they give certain guidance on the treatment of a transaction. Yes, I agree, they are a very positive sign of Malta, that you are pro-business and aim to give certainty to both the taxpayers and investors. And I think it's great to have them, especially being the first in the European Union to have such guidelines.
What I'm seeing is that other European countries, they're following what we're doing in terms of guidelines, and they're trying also to improve on maybe what we've created. What's the take in other countries in your experience? So maybe, Gordon, can you tell us a bit about the US, how you're approaching taxation on cryptocurrencies and blockchain projects? Do you think that the US has a good tax framework when it comes to transactions on blockchain and cryptocurrencies, or there's still room for improvement?
I think when it comes to the United States and it comes to crypto and blockchain, there's so much room for improvement. It's like a chasm. Just be real straight about it. US is lagging substantially in its legislative improvements to take into account this new asset class. And I'll just speak bluntly. It's complicated in the US because we have a structure that Europe generally doesn't have, which is we have the federal level and we have the state level. And even if some states, for example, Wyoming and others, are looking at implementing more appropriate taxation schemes for crypto and for blockchain, it doesn't really matter that much until the federal layer, Washington, D.C., gets their story straight. And so what's been happening so far in the US is not an attempt to revise the law to make it attractive to these projects. It's been an attempt to look at these projects and the currencies and see how they fit into existing law. And sometimes that fit is obviously imperfect because you're dealing with a new sort of thing. Now, just generically, crypto and tokens and the like, they're property of some sort. Really matters like everywhere else, whether it's held for investment or other purposes. If it's held for investment purposes, maybe capital gains kicks in. If they're not, and I've worked with some ICOs, if they're not an investment asset, then when you sell them, you're going to owe income tax on the markup, which is substantial. This is why many companies come to Malta. And you may even own sales tax. So in order to make the US a more desirable jurisdiction, states are looking at alleviating some of those burdens, but until the federal layer gets solved, it's not going to be wonderful.
And from your experience with investors or also businessmen in this area, do you think that they will go more for a jurisdiction where there is specific guidelines and certainty on how to tax, or they still prefer to operate in jurisdictions where the area is still a bit gray and maybe they can still...
The gray zone was maybe nice and useful at the very beginning, but the time is gone when governments and taxing authorities are unaware of blockchain and Bitcoin and crypto. I mean, and now there seems to be a predisposition, at least in the US, against it. It's not like there's no agency that's not awake, and the gray doesn't work for you, it works against you in the area of tax. Maybe in other areas like securities law, the gray works for you, because if you have an innocent mistake, then maybe that actually changes it under law to not be a security in some cases. It depends on your communications. But with tax, the damages are compounding over time. There's an interest rate applied to shortfalls. So the gray zone doesn't work. You want clear and defined law, and ideally you want something like in France, and I think like what you would explain is in Malta, which is when you do crypto to crypto exchanges or transfers, that should not be taxable, ideally, but the US has not taken that position.
In Malta, the position is that if you have an investor who is buying and selling continuously, then that is treated as the normal income. But if it's a one-off transaction and a sale of cryptocurrencies, that is considered as capital, and then there is no taxation on that.
Yeah, I mean, that's sort of the investor versus dealer distinction that you see a lot in administrative law, including tax law, including securities law, and it goes to your purpose of buying. Just like a futures contract, on one hand, can be a speculative investment for someone. On the other hand, for a farmer, it may be a good way of getting security that they're going to be able to sell their crop. Even that, though, has not been so well defined in the US. And I think there's a decent argument. So we used to have something in the US called a 1031 exchange. And the idea is, we still have it, but the general idea is that if you're exchanging like for like property, say real estate for real estate or wine for wine, if you're exchanging those two, and you did it in a certain structured kind of way with using an intermediary, that your basis would pass over to the new investment and you would not have to pay capital gains. And you can keep on rolling forward in time until eventually at some point you sold that real estate or you sold that wine or you sold whatever. Now, under the Tax Reform Act of 2017, all these ways of exchanging property, whether it's wine for wine or boats for boats, got eliminated, and it's just really like-kind real estate for like-kind real estate, which I think is a shame, because you want people to keep on rolling over their investments. And I would have loved for 1031 exchanges or something like 1031 exchanges to apply to crypto and to blockchain. And I think that would be good.
That's a very good argument, and it leads us also to the next question, because whilst we've been trying to tax blockchain and transactions on blockchain, tax administrations have also been looking at how the blockchain itself and the new technology can also be a means how to have more efficient tax administration. What's your take on this, Bernice?
I think before going into it and saying, okay, blockchain will solve every problem that we have to see the technologies that we're using and see which problems they're solving and which problems they're not solving. Then if we go to saying, all right, we need to use the blockchain, what are we understanding with the blockchain? Are we speaking about a decentralized ledger technology, or we might need centralized ledger technologies because we will not be sharing, let's say, data with everyone, having access to it, joining the DLT? Are we thinking about using blockchain simply to record data, or else going a step beyond and automating collection of data? And then there are a lot of problems because you might be enforcing even businesses to start using blockchain. For now, it's, let's say, a choice.
We're a bit far from
even if we're speaking about recording the data, just stopping there, I mean, do we want to be in a position where we tell businesses, okay, you need to use the blockchain? Because at this point, it's something which is voluntary.
Do you think that would be desirable?
I mean, the purpose, why blockchain is being mentioned so much as solving, let's say, the issue of recording data, transparency, is that, you're recording the data, you can access it through obviously joining the blockchain in itself, and then, you could see its past history. So there's an issue of if a company is trading, its books can't be touched in some way. So that will be desirable when you're seeing, paying tax and seeing that you're paying what you owe.
Let me throw this idea in there. Right now, taxes are imposed at timed intervals, and they're also imposed based on certain events, it's part of the nature of our limited accounting system and transparency into businesses and economic structures that lead to it being done this way. There's recognition of taxable events, and whether or not you realize, I don't know if you guys use the same language here, but there's recognition of income, there's realization of income, there's all these events that trigger a tax consequence, but partly because we think that's natural, but partly that happened because that's all we could capture. Like, we don't see every event right now in economic cycles. And maybe to your point, if you have blockchain actively recording transactions and all the accounting systems are on blockchain, it opens up the opportunity for more continuous collections and maybe more appropriately timed collections. So for example, if you have a VAT-style system, like in Europe, and there's a supply chain, and value is being added at certain points along the chain, and you now could set those up as nodes for collection and value capture. So I think
What do you think, Matthew? Matthew, as a VAT expert, so what do you think? Do you think that tax administrations can use blockchain VAT department to facilitate the collection of VAT and transactions, cross-border transactions in the EU?
I'm sure it could be a means to mitigate the VAT fraud within the European Union, which is, you consider the VAT gap of basically between what is actually collected and what is expected to be collected by the government. I think the gap is increasing. In fact, there are certain changes coming into 2020 aimed to mitigate this VAT gap. Using the technology, blockchain technology, which is obviously immutable, as a system would definitely be of importance and of relevance for the tax administration to ensure better collection of tax revenue.
And what do you think? You think it's going to be more challenging, as in from last year's guidelines? We've seen already a change and new technologies coming in. What do you think, for example, in exchanges? The way we saw exchanges last year and the way we applied VAT and income tax to them, and now, for example. You see that the fact that we have guidelines, you think it will help?
Guidelines always help, but given the technology is always changing, the guidelines at one point in time will have little relevance. What is important is that when analyzing the VAT treatment of a transaction is to understand exactly what's happening. There is no hard and fast rule of the VAT treatment of an exchange. An exchange can be treated as a taxable supply because you're conducting sort of an electronically supply service when you're providing a platform via which party A can sell tokens to party B. On the other hand, in the case of an exchange transacting in a coin, for example, in a Bitcoin, and the exchange is effectively buying the coin and onward selling the coin, in light of the European Court of Justice in the Hetfisk case, that particular transaction is considered to be a transaction in currency and would be classified as exempt from VAT purposes.
You're mentioning currency. I know that Gordon is very into this new concept of Libra. What do you think? You think that is this going to have any other new implications from a tax point of view? What's your take on this?
So let me clarify.
I have 10 seconds.
Yeah, 10 seconds. I'm not an advocate of Libra. Okay, that's Facebook's new currency that's proposed. I'm not an advocate of it, but it's the first time ever that a large crypto is being proposed where it's going to be backed by a basket of other currency and low volatility assets. And that basket is going to be actively traded. So there's an interesting question about whether you own this stable coin or low volatility coin if you're going to be taxed on the gain or loss of the underlying basket. And whether or not Libra launches, I have no idea, but these corporate cryptos are coming. You know, we've had no government crypto like Bitcoin. We've had stable coins like Tether. We're heading into the age of government crypto and corporate crypto, and it's a brave new world, and each one of those is going to bring tax issues. So it's a fascinating time.
That's good, so we'll never run out of jobs. So we always have something to chase technology, come up with new taxation methods for technology, and we also will have to see what's going to happen with the digital taxation as well, in the realm of blockchain and all the digital services. So pleasure is yet to come. Thank you for being on this panel. I think there's the next panel now.
Yep. And I want to thank everyone in the audience. I can't believe you're still here. Okay, you are the survivors. So let's give you a hand. Wow, you guys stayed for tax and blockchain. I salute you. We all do. So thank you. We appreciate it.
Thank you.